And, let's be clear, that was their responsibility. So it's not like they wouldn't have to pay it. They would have to pay that even if we paid cash, it would have to come out of the funds because they owe it. And the fact that they haven't, that it all hasn't been paid up, that some of it's been perfected into a lien, this means that they got a break in the sense that they didn't get foreclosed on, but it's still a debt that they owe. So that debt, usually when you're buying cash, there's enough cash there to cover that debt. In a term situation, they're only getting, in this case, they'd only be getting $20K in cash. And if what they owe is more than that in cash, then there's not enough money in here for them to clear off all those issues unless we bring money to the table, which we're not doing.
Can I ask a quick question, sir?
Sure, of course.
Yes, sir. Well, what if the purchase price went up to 200 and then that still would, I don't know if that would do what that would do to cash on cash return, but you're at 12.14%. Would that extra be able to cover the lien and what's owed and then maybe make them happy?
Well, so where you're going is where we have to be, which is that the down payment, independent of the price, because just because they owe more doesn't mean that it's worth more. So just because they owe an extra $20,000 doesn't mean I want to bump up the price by $20,000. They just have to accept the fact that if the market value if they didn't owe anything and the market value were truly 175, then they would get 175. But the market value is 175, but you got 20 some odd thousand in unpaid expenses that are their responsibility. So we could throw it on top, but there's no reason for us to, because they owe it and they should have paid it. They didn't pay it over some period of time. And now that expense plus whatever interest and fees that they accumulated is hanging around the neck of that house, and it's got to get paid. But again, just to be clear, this was their obligation. We're buying it, but it's their responsibility. So you don't get a free pass for not paying your stuff. You just got to pay your stuff when you get ready to sell it. It's relevant for us because it means we're going to need, if we want them to walk away with anything in cash, we would need to bump up the down payment to at least cover the cost of whatever that underlying expenses are, liens or judgments or what have you. And then whatever above that exists, that's what they would actually be able to put in their pocket. So we may need to bump that 20 up to 30 or 40 so that there's enough cash coming in so that they can transfer title property. I'm pretty sure it's been vacant for a while.
Yes, it's been vacant for, I shook my head. I guess you can't see my face. Yeah, it's been vacant for.
Okay, that's a good point. Let me add the video so I can see at least head shakes. So yeah, so this is a situation where we just need to be mindful of the fact that at that closing, forgetting about the B2C, if we're buying it from them for a specific
Mitch,
price.
we got a black square.
Yeah, sorry. Yeah, that's me not finishing my transaction. Here we go. And this, see if I do that, it's going to be in
We're
the way.
good now.
Yeah, it's got that thing. Anyway, at least whoever starts talking, I'll be able to see you on your screen. So we'll just have to keep that in mind. The layout for the spreadsheet is pretty much exactly like cash, except some of the things that were ignored in the cash tab are now relevant. So I'll just kind of point out the highlights. The expenses are same as before, but now there's this, and rents, of course, are the same. Everything else is the same, but this debt service is new. So this is we're going to pay you something on your equity each month to accommodate the fact that we're not going to pay you all your cash upfront. So we'll come back to this. I'm going to talk to you about how we get to this number, but that's what this debt service is. And we'll talk about this when we come back to it later, because I don't want to get too bogged down in it just yet. I want to point out note balance, because this is going to be the difference between what we're paying for it on the PSA and what we're paying down. And it's going to be relevant, very relevant in a minute. So let's talk about the B2C, because the way I typically work terms offers, it's kind of like how I work cash offers, is I work from the back, from the end, from the investor side forward. So my question is, how much can an investor pay for this thing, assuming the repairs that are needed, assuming the income stream that we've got? How much can they afford to pay and still get their, what I'm hoping will be 10% or better cash on cash return? There are a few other factors we can consider, but let's start with that. So just to remind you, cash on cash return, is going to be this cash flow, 17,344, divided by the all-in for the deal. And the all-in is going to be the down payment, the estimated repairs, and the closing costs. Because again, for the investor, we're not paying their closing costs; they're paying them themselves. And I don't know if you guys know this, you probably do, that if you double click on a cell in Google Sheets, it shows you the formula here, and it also highlights what's making up that formula. So I can see these are the three things in the denominator, 20, 150, and 2,500. I can see that's in the numerator, and they're color coordinated, so it's kind of cool. Anyway, so my formula is right. So what this is telling me and let's ignore the purchase price for now, because purchase price for a terms offer isn't going to impact cash on cash return. All that matters is the down payment, the repairs, and the closing costs as far as the denominator. And repairs are going to be fixed and closing costs are going to be fixed. So all we get to fiddle with is the down payment. However, down payment's got to be bigger than whatever the down payment is on the A to B, because that spread is going to be how we collect our fee. So, and now we have the additional information that there's going to need to be some cash floating around in this deal that the seller gets so they can pay their back fees. So let's bump this up to like 40. And it doesn't have a significant, it has a 1 point drop in the cash and cash return, 1.5 point drop on the cash and cash return. It's not horrible, but so I'll typically start with that. I'll start playing around with that because I want a healthy down payment from my investor. So let's even go, let's go to 45. And just to be clear, for somebody buying a piece of, in this case, fourplex, commercial real estate, 20% down is not unreasonable. In fact, 20% down is pretty much what you'd expect to put down on a property like this or anything larger. So I'm okay with getting into the 20% range because we're still talking no bank financing. This is going to be seller finance, and I can have to deal with the bank. It's going to be quick, easy, no junk fees, no personal guarantee. So I'm okay with pushing the limits on the down payment. So $45,000, let's just kind of play around with that. I don't care so much about the purchase price for now. We can come back to that later. That will be relevant for the note balance, but we'll talk about that in a second. Let's talk about debt service. $1,200 is, this is a fourplex. That's what, $300 per unit. It's been on the high side. I know we want to try to get the maximum amount of debt out of this thing, but I also don't want to suck all the juice out of the deal so that the investor can't make any money. So let's back off on this a little bit. Let's back off to about $1,000. Still decent. Oh, couldn't have planned it better myself. Still a decent payment, but, and 5.6% is an acceptable rate. That gets us, again, I didn't plan this, exactly 10% cash on cash return. Okay, so for now, again, this will be an iterative process, but for now, our work is done on the B2C. Let's take our attention to one quick thing before I leave this. This $1,000 payment that the investor is paying to us every month is interest only. So this 5.6% is interest. The balance is $170. So this $1,000 is monthly. So the $12,000 that they pay us annually represents 5.6% of this $170,000. And that's relevant because it means that the loan balance, the note balance, is not going to change from year to year. It's going to be exactly $170,000 in year one, and year two, and year three, and year whatever, because they're only paying the interest. They're paying no principal on this thing. And that's important. But so now we have 45 down. So we have $45,000 to play with. Let's see what we can, and that would get us a $22,000 wholesale fee, which would be not a bad deal. Let's see how much of this we can use in the A to B. So we got 45,000 here, which means we could pay, in theory, up to 45,000, but we don't want to pay the whole thing because we want to make some money when we close this thing. So let's say we pay, I don't know, let's say 30. And again, we'll need to find, you're going to want to find out, Sassy, how much money has to be paid at closing to cure all of the defects that are in the title. Whatever liens have to be paid off, we need that. You'll need that amount, because whatever that amount is this has to be bigger than that. Otherwise, they're going to have to come to a closing with cash, and they're not going to be happy about that.
It's
So-
definitely under, it's like I said, it's about 26,000. That's only I see for the property though. Like, I don't know what other liens are on the property. And usually you don't find that out until it goes to the title company and they run title on it to see if if it's a dirty title and all that good stuff. But
Yep.
it's definitely under 30,000.
Okay, and we would say in our PSA, if there are, any liens, anything that's required to clear the title is responsibility of the seller. So if there's additional expenses that pop up, that's understandable, but it's going to come out of your end because these are your responsibility. Your meaning the seller, not you. So, but if let's say it's 26,000 all totaled, that means that they would actually walk away from closing with $4,000 in their pocket, which, that it is what it is, right? We don't owe 26, they owe 26. So the fact that they owe it, it's owed. It's a legitimate debt. They have to pay it, but we're paying them 30, so they get to walk away without having to pay any money, and they walk away with $4,000 in their pocket. If we pay them 30 and we collect 45, then that's a $12,500 wholesale fee, which is not bad. And life is pretty good. However, there's one other thing we have to be mindful of, and that is the note balances. In this case, we're cool that the note balance we have with the investor. So what the investor owes us and will continue to owe us for the entire duration of the term, because it's not going to be paid down, is $170,000. So that's important because when we get, let's say it's a 5-year note, let's say 5 years from now, we require that the investor pay us off, and we offer to the seller that we're going to pay them off in 5 years. 5 years from now, we will have paid assuming that this is debt services that we keep it at 900, that's $4,500 a year. That's under $25,000 total. So the note balance will be about 125, let's say, that we owe the seller. However, the investor will owe us the same 170 that they owed us at closing. And what that means is we'll make money at very least 3 ways on this deal. The first way is at the closing, the closing to acquire, when we collect the spread of the 45 that the investor is paying us compared to the 30,000 that we're paying the seller. So that 15,000 minus the $2,500 that we're paying to the closing costs, that 12,500 we get to pocket. That's our wholesale fee. That's one way we get paid. The other way we get paid is the $100 that we're going to be seeing between what we're getting paid each month by the investor and what we're paying to the seller. I'm probably going to adjust that, but for now, let's roll with it. $100 a month. And then finally, 5 years from now, when the investor cashes us off, they're going to owe us $170,000. We're only going to owe the 145 minus whatever we paid in principal pay down, which will be whatever it'll be. But let's just say it's 125. That means that's $45,000 spread between what we're owed and what we owe, which means we get paid a third time at the closing, at the closing in 5 years. When we're getting paid off, we get another $45,000 that will make us very, very happy. So that's a good deal, but you have to keep an eye on the note balances to make sure that the note that you are owed is not smaller than the note that you owe the seller. So if we didn't bump this up to 215, if this were like, 180, then we would be owed less than we owe. And it's possible that there'd be a scenario where we would have to come to the closing to pay off the seller more money than we're getting from the investor. We don't want that. So we have to just keep an eye on that note balance. My recommendation is to make sure that they start off equal, because we're going to try to amortize as much as we possibly can. We'll make this $900 all principal.
Don't forget to like, subscribe, and click the notification bell to get updated on our new upcoming videos soon. Thank you so much for watching.